Hi, I'm Pattu from FreeFinCal, and in this video, let's discuss a strange mutual fund fact, something that every time I see it, I get amused and surprised. Many people ask, how do mutual funds manage to beat the index? Well, this is essentially how they manage to do it. So let's look at the FreeFinCal mutual fund screener that's published every month. This is the December 2018 screener. You can download it from freefincal.com. In the main menu, there's a link for that. And so what we're going to look at is the results and the kind of columns that we have for screening. I've explained this in previous videos, but for the sake of this video, let me explain this again. So first of all, look at the count that you see here. Can you see at the bottom? I'm circling the mouse. That's 233. That's the number of funds that we have in total for screening. And you see here, so we have number of rolling return entries for the index and for the fund. So we are comparing for just one of these funds. We are comparing, let's say, quantum tax saving. You're comparing 1,710 3-year returns of the index and 1,710 corresponding 3-year returns of the fund. And we are saying that the fund has bet the index 741 times out of those 1,710. So that's 43% consistency in beating the index over every possible 3-year returns. So that's the rolling return consistency. And there's also something known as the upside performance consistency. That is, over those every possible 3-year returns, we look at months. We look at the monthly returns and we look at months when the index moved up, let's say by 10%. And then we found out how consistently the fund has bet the index monthly return. So let's say the index has moved up by 10%, the fund has moved up more than 10%. How consistently does this do? Does the fund achieve this? That's called upside performance consistency. And then there is the opposite called the downside protection consistency. So let's say the fund has moved down by 10%, minus 10% return in a month. We find out if the fund has fallen less than the index or more than the index. If it has fallen less than the index, then it's good. So that's called downside protection. So we're going to look at what is the way in which mutual funds beat the index. Do they do it with by beating the index when the index is moving up, or do they do it by beating the index when the index is moving, when the index is falling? Which is easier? Upside performance is easier or downside protection is easier? Many people tend to think that look, whenever there's a bull market, all the funds will do better. Its upside performance is easy, but that's not exactly so. Data doesn't give you that evidence at all. So what we're going to do is go back to the screener input page, and we are going to demand out of these 233 funds, we're going to look at every possible 5-year return period, and we're going to look for 70% consistency. That means 70% of those 5-year returns studied of the fund should be greater than the benchmark considered. So when we do that, immediately that number drops to about 112. So only 112 funds out of those 233 considered have got a 5-year rolling return consistency greater than 70%. But the 5-year data is on the right side of the screen. You don't see it here. Now we're going to ask, out of that 112, how many funds had downside protection consistency greater than 70%? That number is 87. 87 out of 112 is decent, right? So then we just write down these numbers. So 87 out of 112 downside. And now we are going to ask, so what we're going to do is we are going to clear this downside protection. So we are back to 112. Then we are going to ask, out of this 112 funds which have bet the index consistently, how many had upside performance? And that's just 28. This is the fact that just keeps baffling me every time I see that. So most funds do not beat the index when the index is moving up. Most funds produce the so-called alpha, or most funds produce outperformance more consistently and more easily when the index is falling down. They tend to fall less. So that's where the active management actually plays a role. and this is over 5 years. We can repeat this experiment over 3 years or 4 years as well. Let me do it over 4 years if you like, back to 233. So we're going to ask for 70% return outperformance over 4 years, and that gives you 119 funds. Let me just write that down again, 119, and we're going to look for downside. So we're going to look for consistent downside protection of 70% or above over 4 years, and that's 91 out of 119. And if you just remove that downside screener and go back to 119 and demand 70% upside performance over 4 years, it's just 31 out of 119. So downside protection 91 out of 119, upside performance only 31 out of 119. So this is over 4 years. If you're patient, we can look at it over 3 years as well. Clear all filters, back to 233. Expect return outperformance first for 70% consistency over 3 years, and that's 103. And if you add the downside protection filter of 70% or above over 3 years, that becomes 66 out of 103. Remove the downside filter, back to 103. If you ask what is the upside performance, that is 70%, demand 70% upside performance over 3 years, you get to 18. That's just crazy. That's I mean, 66 funds have got 70% or above downside performance out of those 103 funds which have consistently bet the index, but only 18 of them have got upside performance. That is the reason why I keep saying upside performance is of no use. Don't worry about funds that do well when the market is moving up. You worry about funds that do well when the market is moving down. That is where so if you are interested in active mutual funds, downside protection is the key point. And this is why I keep saying the journey matters. When you look at a return, or let's say 20% over the last 5 years or 6 years, the journey matters. That's why I said there's no compounding in mutual funds. The journey matters. During this 5-year period where if you are 20%, there would have been falls and highs. Beating the index when the index is giving a high return does not matter. Protecting the investor from falls when the index is falling, that is the key to alpha generation over long term. You take any fund over that has got a 15-year, 20-year, 24-year period history, and you calculate the upside performance and downside performance. This ratio is this upside capture and downside capture ratios are available at Morningstar. You look at that, and I guarantee you practically every fund would have had poor upside performance but very good downside protection if their long-term returns are very good. And that is the that's an amazing fact. Every time I see it or talk about it, I'm just amazed about it. But you can perhaps argue that it is natural, but it's not intuitive. So I hope I've been able to put forth what I wanted to say in this video. I'll catch you in another video. Bye bye.